Uh, David Waddell, CEO, Chief Investment Strategist of Waddell and Associates. Thank you for tuning in. This is a rare occasion where we decided to do this week's Strategic Insight live, given how dynamic the environment is, and I think how important this information is. And so thank you for being with us. I also owe a serious thank you to the associates at Waddell and Associates who have worked really hard in the last 48 hours to pull this all together, especially when we're in the midst of spring break. And so, they're always willing to be on the job site to do whatever they can to sort of help and comfort clients. But there was a little bit of a special sacrifice made this week with little ones. So anyway, I'm super grateful for all of their attention to this and prioritizing you all. But if you see the associates around, say, hey, thanks for taking time off vacation to help with this. So as I was thinking about the purpose of this presentation this morning, I was reminded of a routine that I had within my family over the course of my development. So many of you knew my father. He is no longer with us, and I miss him every day. But what I miss most is whenever the world got weird, I would call him up. He'd say, come on over, let's talk about it. He'd pour me a scotch. I'd sit down. He'd clarify things for me. I'd feel comforted, more confident, more secure. I'd go back out into the world. Things would get weird again. I'd call him up. He'd pour me a scotch. And we went through that routine for most of my life. I won't tell you when he started letting me drink scotches. So as I was thinking about the experience I want you all to have with Waddell and Associates, it's very similar to that. The world is nutty. It's crazy. I want you to come to Waddell and Associates like you're doing virtually today. And although we can't pour you a scotch, and maybe some of you don't even like scotch, which I can't understand, by the way, but we want to give you clarity and give you comfort and give you confidence that we're on top of it. We understand the dynamics and that your money is safe at WNA. We are your safe harbor. That is job one here. Markets will ebb and flow. Sometimes we win, sometimes we lose. The financial plan batting average is very high, so I'm very proud of that. But we're not going to subject ourselves to idiosyncratic risks, any sorts of craziness. We're not going to lever up your assets. But I did want to talk a bit systematically about what I'm seeing in the marketplace today, specific to the financial system, but then also talk specifically about what we do here at WNA to safeguard your assets, also look at the counterparty risks, and just give you a parting, injection of confidence, I hope, so that you can go about your day and feel a little better about things. Now, I am not alone in this presentation today. I have asked Sean Gould, our newest partner, to also join me to talk specifically about WA, our custodians, and things we're doing to secure your assets. So that is the mission of today. Absent the scotch, I want you to sit down. I want you hopefully to gain some clarity, feel confident and secure, and then go back out into that crazy world, and we'll do it again, unfortunately, I'm sure. All right, here are the disclosures. Take a moment, glance at those. They'll be available in the replay. Enjoy at your leisure. All right, I'm going to start with what's going on in the markets today and the macro mechanics behind it. It is mission critical in understanding where we are today to go back to the biggest economic event that maybe ever happened in the history of the United States, which was COVID, in terms of the crazy dynamics. Obviously, we had big GDP moments like the Great Depression, et cetera, but COVID was singular and peculiar in so many different ways. And recall that during the COVID stimulus project, as Americans, be us businesses or governments or individuals, we received $5 trillion in capital injected into our system. So $2 trillion as individuals showed up in your mailbox, another couple of trillion as businesses, state and local aid, healthcare, other. It was a $5 trillion payday. Okay, all that capital came into our hands. So what did we do with it? We took it to the bank. So this chart here shows you the quarterly change in deposits of billions of dollars across U.S. commercial banks. And you can see this hockey stick higher that neatly actually comes to $5 trillion. I was sort of surprised that it was that close. But the stimulus went straight to the banks, right? Whether, it went to a business or an individual, it ended up washing up into the bank's system. And you can recall, going back a couple of years, headlines that banks didn't even want deposits anymore because they were overstuffed with deposits. Well, deposits did show up into their coffers and they had to figure out what to do with it. So remember, we live in a fractional banking system where money comes into the bank takes it, loans it out by a factor of 10, in the expectation they're not going to draw out your money the next day. And so that a run on the bank merely means that you draw deposits down faster than they can create liquidity. But so much money was flying into the deposit facilities within banks that they couldn't loan it out fast enough. And because so many of us Americans benefited from the COVID stimulus directly, we didn't have that big a demand for loans. So they were overstuffed with deposits. There wasn't that much loan demand. And so what they did was they bought treasuries, right? And they bought risk-free treasuries. And that's not a pun. The US government never defaulted on a bond. And so for purposes of Finance 101, we understand that the risk-free rate is the US Treasury rate. So risk-free, no chance of the government defaulting, even though I know it makes a lot of Twitter sort of handles happy. But what's interesting about this chart, go back to 2008 in this chart, and this is bank cash and treasuries as a percentage of total bank assets. So only 12% or so of bank assets back before the great financial crisis were in treasuries. The rest of them were loaned out in subprime loans and sophisticated, crazy structures and all sorts of zaniness. This go round, 38% of total bank assets were actually in treasuries, right? Which gave the feds great comfort, which leads to the talking points that the banks are better positioned today than maybe ever before. And there is some truth to that. This is the FDIC's view of problem institutions. So they put out a report every quarter. You can go to the FDIC's website and see it. And they have their standard of, solvency for banks. And then they release not the bank's name, but how many banks are on their problem list. And as you can see, in 2022, only 39 banks were on their problem list. Compare that to 2013 when 467 banks were on their problem list. So really the banking system, by way of measurement of the FDIC, again, so much of the bank assets being in US treasuries is safer than ever before. But there's a rub. Inflation started rising, as you know, as a consequence of all that stimulus, all the spending, the lockdowns, the shortages, the slow recovery in the labor force, et cetera. And so inflation spiked up, hit a high in June of 9%. We got a reading just recently down to 6%. So we've already cut it by a third. We talked about that in the outlook. Nonetheless, while inflation is surging to 9%, the Fed's target is 2%. And so they got to raise rates. And they did. They increased interest rates rather dramatically, as did the marketplace itself. So what I'm showing in this slide is the change in the US Treasury bond curve, right? 3-month treasuries, bottom left on my screen, hopefully yours as well. And then through 30-year treasuries, bottom right. Well, that curve ended up shifting dramatically higher to where the 3 months, which basically approximate the Fed funds rate, got up to 476. And you can see the 10-year up to 388, the 30-year up to 4 from 2, essentially. That sort of dramatic rise in treasuries also in treasury yields for bond holders creates dramatic declines quickly in the value of the bonds. So last year, long-term investment grade bonds and long-term treasuries lost about 30%. Okay, these are treasury bonds, no risk of default. However, the rapid increase in interest rates led to a rapid decrease in price to calibrate the two. And that led to these tremendous losses, right? And the total bond market itself was down 13% or so, as you recall. And that ended up, even short-term intermediates like 7-year, even shorter-term duration stuff was injured in this process. So if you owned risk-free bonds last year, you on paper lost a whole lot of money. But these risk-free bonds only lose money if you have to sell them. So this chart, you've seen this floating around on the internet if you're tracking any of this stuff, basically displays the unrealized gains or unrealized losses of investment securities on U.S. commercial bank balance sheets. And again, as those large portfolios of treasuries, as the yields went up in value, the returns end up being negative. And so on the books right now across the U.S. banking system is about $650 billion of unrealized losses that, again, don't matter if you don't sell. Because if you hold the bonds to maturity, you bought it for 100, you sell it, for 80, you take the loss. If you hold it until it matures, you get your $100 back, right? So all you got to do is hold these bonds to maturity and you're fine. Well, this is where things get interesting. As the Fed is raising interest rates, the net interest income for banks has gone through the roof. So there's no real reason for the banks to have to sell these treasuries because they're minting profits, right? So the amount they're paying you on deposits and the amount that they can receive, not really even on loans, like why bother going to loan? Just go buy some treasuries. That spread is so juicy that net interest income for banks has gone through the roof. So all is well. Here's that spread I was talking about. This is probably the most important slide in the presentation in my head, at least on the economic side. So right now, if I'm a bank, and I know we've got bankers on the call, and so don't be mad at me, but if I'm a bank, on the deposits that you put in my care, I will pay you roughly 0.45%. Okay, so you take your $1 million, you put it in my sweet checking account, I will pay you 0.45%. I will then take that $1 million and I will buy basically T-bills, which I'm representing here as money market mutual fund rates of 4.45%. So there's a spread of 4% in here to the benefit of the bank. Seems like a pretty good deal for the bank. Not as good a deal for the depositor. Now, in the environment we're in, where people are concerned about the credit worthiness of the bank because of the unrealized losses in those treasury securities, you're doing this calculation in your head. You're saying, all right, with that $1 million, I can give it to the bank, which may or may not be able to give me $1 million back. And for taking that risk, they'll pay me 0.45%. Or I can take that same $1 million, put it in a money market fund that's basically holding overnight treasury bills, and I'll get 4.5% for basically taking no risk. So should I prefer 0.45 taking risk or 4.45 taking no risk? This is what's leading to the run on the bank. This is also why it's nice that we're guaranteeing all these deposits, but I don't think that's the root issue. I think it's cash sorting, as they call it, which is just people saying, I don't want to earn 0.45% on my money taking risk. I'd rather earn 4.45 on my money taking no risk. Therefore, I'm leaving the checking deposits reservoir and I'm going into the money market reservoir. So it's really that choice, I think, that matters. And so depositors have taken notice and they have started moving their assets out of the banking system into the deposit system, I should say. So here's the quarterly change in deposits of billions of dollars. So remember, 5 trillion went in, and this is through, I guess, the end of the fourth quarter. Because is that right? Yeah, because the first quarter hadn't ended. So we hadn't even gotten the next number. The next number is likely, there's another 300 billion or so. So let's say 5 trillion went in, $1 trillion has now come out. That is forcing banks to have to contemplate realizing some of these unrealized losses, which is why the Fed has stepped in significantly by 300 billion recently to help shore up bank liquidity. So it's forcing banks again to realize these unrealized losses. So they're sitting on 650 billion of losses. And if the Fed doesn't help them out, which they did with the emergency facility, then they're going to have to sell these bonds, take the loss to meet the deposits, and it's just a downward spiral. This is what creates a run on the banking system. It looks like 1907. But we didn't really have an active Fed then, so I'm not that concerned. But in this cycle where we've raised rates from 0 to basically 5% within 12 months, people have been waiting for something to break. I mean, we've been waiting for something to break. Last year, in about October or late September, when the dollar got up to 115, we're at 104 today, that was putting significant pressure on overseas borrowers who had borrowed in dollars and were having to pay back with their currencies depreciating and the dollar appreciating, just onerous levels. And that hurt, obviously, in the UK. We had that sort of issue there, which led to a restructuring of the government. They kind of hit the wall. We saw issues in Italy and in Asia, et cetera. And so my concern at the time was we're getting to a level where the financial crisis could be sovereign debt. And that would have been triggered by the runaway advance in the US dollar. Well, fortunately, the dollar found its way lower, and a lot of those risk measures came off the table, which also coincided, by the way, with the advance in the markets off of the October lows. And so anytime the Fed goes on a significant tightening cycle, something breaks, right? So everybody's just been kind of waiting for the shoe to drop. And it didn't end up being sovereign debt. It ended up being this bank issue, which is not a credit quality issue. This is not 2008 where they've got a bunch of ninja loans out there and houses that they're taking in that they have to sell at dramatic discounts. That's not what's going on here. It's really an accounting issue where their treasury bonds have lost money and they may have runs on the bank. They got to generate the liquidity, sell them at a loss. That creates an issue. And so finally, we figured out what the something is that breaks during this tightening cycle. And that something is just regional bank liquidity. So we've seen our first bank failures since COVID. I think there were 3, maybe on the next slide, in 2020. But Silver Lake Bank went away. They were banking crypto firms. That was a bad idea. Then you had Silicon Valley Bank, which was banking, profitless tech companies. Additionally, they owned the highest yielding treasury bonds that money could buy, which meant they were way out the curve. And so they got that huge duration problem. And so Silicon Valley Bank went away. They declared bankruptcy this morning. And then Signature Bank went away. That was another bank that was heavily levered into the crypto space. By the way, there is a difference between Bitcoin and the entire crypto apparatus. Bitcoin is a token. The crypto apparatus is basically a fraud. They are two different things. Bitcoin may prove to be a fraud, but a lot of the businesses that were built around it certainly have proven to be frauds, and some of the largest in history. So anyway, a lot of those companies banked with Signature Bank. Not good if you're Signature Bank. They went away. So then you've got Credit Suisse and First Republic Bank. Credit Suisse is just a bad bank and has been for a long time. Just sort of rancid management, terrible risk controls, lots of fines, lots of regulatory problems. I mean, I don't think it would be systematic if they went away, because at this size, they're not all that big, but they sort of deserve the punishment they're getting. Nonetheless, the Europeans have stepped up and injected a bunch of capital, and they'll probably survive. It's an old franchise. They're in Switzerland. We'll see. As far as First Republic, that's really just sort of a Twitter raid where I don't necessarily think that First Republic's a bad bank. But if everybody decides all of a sudden that they don't want to hold any of their deposits there, then they have a run on the bank and they got to deal with the consequences of that, because it's a fractional banking system. So yesterday, a consortium of banks came together, the largest banks, and dumped some money into their deposits, $20-30 billion or whatever, which ironically means if I had an account at First Republic and I put it into JP Morgan turned around and put 0.14% of what I sent to them back in First Republic. So it's very circuitous. Will First Republic fail? I don't really know. The Fed certainly don't want it to. It's not a bad bank, but it has certainly been surrounded by some shaky confidence. So we shall see. But I do not believe that this is the great financial crisis 2.0. So there it is. In 2020, 4 banks failed. This is the number of banks failing per year going back to 2001. And as you can see, during the great financial crisis, we were losing 140, 150 banks and continued to lose a whole bunch until we got past the Euro crisis and everything into 2015. Now, that was really a solvency issue. These banks owned a bunch of things that were rancid. Solvency problem. What we're dealing with now is a liquidity problem. They own treasuries. So it's not really that what they own is rancid, regardless of your opinion of how the Treasury runs its finances. It's not, a subprime mortgage loan. It is a Treasury bond, but they do have this liquidity problem. And really the entire fractional banking system exists on confidence. So if there's a run on bank confidence, there ends up being a run on bank assets, and the feds have to do what they can to shore up confidence, which they're in the process of doing right now, which is why they guaranteed the deposits at Silicon Valley Bank. So I'm going to give you the bottom line here, hoping that makes sense. Again, I didn't have the opportunity to script this and haven't said all this out loud, so you're inside my head at this point. But here's the macro mechanics bottom line. Number one, an oversupply of COVID stimulus led the banks to park excess deposits, right, things that they weren't loaning out, into risk-free Treasury securities, which was good from a quality standpoint. But the Fed raised interest rates nearly 5% in less than a year, which we hadn't seen a move like that. I guess there was that move in the 80s, but there were also 1,500 bank failures back then. They raised interest rates nearly 5% less than a year to battle inflation, and that compressed the price for risk-free treasuries down about 20%. I'm using 20% as a catch-all. That's about what 10-year to 15-year treasuries did last year. And that led to big paper losses on bank balance sheets. The banks continue to pay depositors 0.5%, while the depositors, if they just ask their banker for a money market, can get closer to 5%. And that's leading to this capital migration out of checking accounts into money market accounts, which accounts for somewhat of a run on deposits in search of higher returns. The banks are then forced to sell the risk-free securities, and that's what happened to Silicon Valley Bank. They realized that to meet their withdrawal request, they were going to have to sell $2 billion worth of treasuries, or mark a loss, I should say, of $2 billion on their treasuries. They had a capital hole, and then they announced it, and Goldman Sachs went out to try and fill it, and suddenly everybody realized, that may fill the hole today, but now that the confidence is broken, more deposits will flee, that hole will get bigger, and that's the spiral that ended up taking it down. The Fed implicitly has insured all of the bank deposits. Yellen was on the Hill yesterday. She seemed to backtrack from that, but because, how can you afford to do that? They created a one-year loan facility so I can swap out my 20% loss on my treasuries for par, and I can get par value. It's a loan, and I can use that to backstop my deposits. So I think that's good, but I don't think it's sufficient, because I think the bigger issue is the spread between the deposit rate and the money market rate. And as long as that exists, the incentive will continue to be to drag your money out of the deposit pool. So it halts the panic, but it doesn't stop the deposit migration towards higher yields. I don't run the Fed. Kind of wish I did. Please write your congressman. I believe this ends the Fed tightening cycle, or should. So the conundrum, if you're Jerome Powell, is, well, we still have inflation around, although I would argue that's backward looking. Therefore, we need to signal that we're going to continue to fight inflation by raising another 25 basis points next week, which also signals that we have a lot of confidence in our regulators' ability to sturdy the banking system. The European Central Bank raised 50 basis points to that end, saying we see inflation as a problem. We're going to deal with that. The regulators are going to deal with what's going on in the banking system, and we don't think there's a problem there. I'm reminded that Jean-Claude Trichet, who was the ECB chair back in the great financial crisis, also raised interest rates, which just exacerbated. So if I was Powell, I wouldn't raise rates. The whole reason you raise rates to begin with is you invert the yield curve, right? So that short-term rates are higher than long-term rates, which stops the banks from spending or loaning. And I've talked anecdotally to several bankers. They're not loaning money right now. They got to go back and fix their balance sheets, et cetera. So if the whole point of raising rates is to invert the yield curve so banks stop lending, they've gotten there. I'm not sure that raising rates really does anything at this point except save face if you're a Fed official. So if it was me, I wouldn't raise it. So this is not the beginning of another great financial crisis because we don't have a solvency issue in the system. We have a liquidity issue. So I don't see a bunch of bank failures, but I do think this is the beginning, finally, of this much anticipated recession. And the reason why the recession has been delayed is because the banks have continued to hold that deposit rate down low enough where for them, even though the effective yield curve was inverted, they weren't really inverted. Now, banks aren't going to get away with paying you 45 basis points to take risk when you can get paid 5% to not take risks. And so that yield curve inversion is finally going to bite. Credit is going to stop moving in the system. We'll end up in a recession and the Fed will have to cut rates. All right, so this is a bit tongue-in-cheek, but it occurs to me that all of this was man-made. First, you had the government, which gave people money. That was the $5 trillion in stimulus. And then the people gave the money to the banks. That was the $5 trillion in deposits. And then the banks gave the money back to the government in treasuries. And then the government raised interest rates. The treasuries lost 20%. And now the government is bailing out the banks with the people's money. So I give this to you a little tongue-in-cheek because it seems kind of nutty, but this is the cycle of what's happened here. And the Fed did end up doing quantitative easing. You can argue it is or it isn't, but they increased the size of their balance sheet, which means they printed money to the tune of about $300 billion over the last, month or week or so in terms of how to manage the liquidity issues at the bank. JP Morgan put out a note saying it could take $2 trillion. So we could be back in the quantitative easing spectrum. We did go through this. We had a minor liquidity panic in 2018 that led to Powell cutting rates. That led to quantitative easing beginning again, and that led to a significant rally in 2019. So I don't know where it all goes, but the government is definitely in the bailout business again with the people's money for the benefit of the people's. All right, let's talk specifically about the WNA portfolio and the implications of all of these macro issues to what we're doing here. All right, first of all, we have financial exposure. So what I'm showing you is the sector weightings. These are not returns. These are percentage weightings within our portfolio. And you can see financial services comprises 15% of the WNA portfolio. So 85% of the stuff that you all own as investors through our portfolio is not in financial services. And that's slightly underweight our benchmark, which is the all cap world index, not dramatically underweight, but a little bit underweight. The question is, which financials? So we have exposure, that 15% exposure, but within that exposure, we are very diversified and we are very quality heavy. So Berkshire Hathaway makes up the biggest, Berkshire Hathaway is an insurance company, which is how Buffett gets to make all his money and not pay taxes. But Berkshire is basically 0.6% of the portfolio overall. Then you got JP Morgan, you got Morgan Stanley, you got Wells. These are all strategically important banks, meaning that the government has guaranteed all of their deposits. These banks are seeing tremendous inflows of capital, not outflows. That's the key metric. If all you're looking at is where the runs are happening. Visa and MasterCard are transaction processors, as you know. Bank of America, also a significant bank. HSBC actually bought the international, I think, remainder of Silicon Valley. So they're a buyer during this period. And then Goldman Sachs, they're diversified, and AIA is really an insurance outfit. So the top 10 represent 2% of our entire portfolio holdings. Our bank exposure is with these large, strategically significant banks. We are not in roach motels, like Silicon Valley Bank. On the bond side, I mean, we've got a big allocation to fixed income and bonds here as well across clients' accounts, called for by their financial plan and the rate of return required to make all their hopes and dreams come true. But what you'll see is we have very little exposure to the most interest rate sensitive sectors of the bond market. So we've been really underweight treasuries. We've been really underweight mortgages and municipals, things that are really, really rate sensitive. We've been away from for quite a while now. If you look at the duration of the portfolio, remember the 30-year treasury went down 30% or whatever it was. We're running a duration of about 2.5 years. So we are very short term in the way the portfolio works, and we're picking up yields at this point between, call it 5.5% and 6.5%. So this may change based upon the environment we're in. If the Fed starts cutting rates, then we'll go back towards more rate sensitive areas of the market. But we have stayed away from the kind of problems in our client portfolios that have bedeviled the portfolios within a lot of these regional banks. We did not go chase yield. We stayed short in our duration, and we avoided the big drawdowns. All right. With that, what I want to do is shift the conversation a little bit and pull in my colleague Sean Gould to talk about, okay, that's the macro stuff. That's what's going on to the portfolio, but it's capital on somebody's books that W&A is directing. And we need to talk about how we are safeguarding your money. Remember, this is job one. The most important thing we can do as a fiduciary is ensure that your money is safe. You're going to be subject to market vagaries, but overall, we need to know that our service providers are going concerns and we're not caught up in the melee that is the marketplace today. So with that, Sean, I may color in some comments because it's going to be hard for me not to, but I'm going to pass it to take you through this part.
Thank you. Yes, David. And I'm going to reiterate, again, the most important thing we do as a fiduciary for our clients is safeguarding your assets. So I'm going to walk through how we perform that due diligence at each level of counterparty risk and give hypothetical examples for you of what happens if something weird happens at W&A or Charles Schwab, and what would that mean for you and your accounts. So I'm going to start at the first level of counterparty risk would be the W&A risk. So you choose us as your investment advisor, and it starts with the team. And it sounds cliche, but we hire for character first, capability second. We look for integrity in everything that we do. So it starts with the team, and there's our smiling faces there, but that's the first layer of protection, is having integrity on the team to safeguard your assets. So when we come on as your advisor, we have the authorization as limited power of attorney. Okay. So what does that mean? That means we can trade in your account on your behalf. So we can select the investments and trade the accounts. We also can represent your interest in shareholder matters like proxy voting. We can deduct our agreed upon fees from your accounts. We can move money as you direct us to like titled accounts. So what that means, for example, is if you needed cash, we can send cash with your authorization to your bank account. Only with your authorization can we move the money to your accounts.
So Sean, there's no way for you to tap into a client's account, move it to David Waddell's household checking account.
That's a great point. Everything is completely segregated by law. We are a different entity than your specific accounts. We do not have the power to move money only to your like titled accounts. That's the only authorization we have. And then another key segregation is we have a third-party custodian that I'll review here shortly. We do not generate portfolio statements. The custodians do that. So you get independent statements from Schwab, from Fidelity, that shows your underlying assets. That's not commingled or mixed in with any W&A assets. So if W&A were to go away tomorrow, which we're not, that you'd still have your Schwab or Fidelity statement. You still have your account, your underlying assets would still be there. So the next level of counterparty risk I'm going to talk through is the custody risk. So we have selected Charles Schwab and Fidelity as our custodians of the assets. They're the actual dealers that hold the assets. And just looking at the key performance indicators for these entities and our confidence for them both as a going concern, Schwab currently holds 7.4 trillion in client assets. Their net income for 2022 was 6.6 billion. And if you look at client flows, which is obviously important for the health of a business, they received 42 billion in net asset inflows in February alone. And then if you look at March, they've received on average 2 billion a day this month. So asset flows are extremely healthy. If you look at the stock price, because Schwab is a publicly traded company, after the volatility of Silicon Valley Bank and all the news over the weekend, there was some downward pressure on the stock price initially on Monday. You've seen Schwab's stock price bounce over 20% since that low. So there's confidence on the markets as well that Schwab is very healthy as a business. And then looking at Fidelity, Fidelity is private. Fidelity is actually larger than Schwab. They hold 11 trillion in client assets. Their net income for 2022 was over 8 billion. They received 466 billion in net asset inflows in 2022. And Fidelity, one difference that not only are they private, they also don't have a bank, where Schwab does have a banking arm that I'm going to go through. So that is one difference between Fidelity and Charles Schwab. So taking a step back and looking at the banking side for Schwab, Schwab is the 8th largest bank in the US. So, very healthy in terms of assets on their balance sheet. One key difference that I want to talk about is looking at what happened with the two banks over the weekend that failed. Schwab has over 80% of client assets insured dollar for dollar by the FDIC. As comparison, thinking about Silicon Valley, Signature, they were closer to 2 and 20%. So very vulnerable with the bank run, which is what happened, where Schwab is extremely healthy as far as FDIC insurance. Schwab also has access to over 80 billion in borrowing capacity. So that's more than their uninsured deposits in total. So if there was a significant liquidity issue, they have a backup for liquidity to where if clients needed cash could immediately be resolved there.
One thing I'll also add, Sean, is I started my career at Schwab. I worked in the strategy group. I knew Charles Schwab. He is the most conservative person I have ever met. I mean, there were plenty of places where we wanted to go with that business where he was like, nope, nope, nope. So Schwab has been safe harbor, and we lived through the great financial crisis. And I knew people that had assets for clients, custody, places like Lehman Brothers and Bear Stearns, and that was a train wreck, right? Schwab was a really safe harbor during that storm, and Chuck continues to man the wheel there. So the majority of our assets are at Schwab. We have assets at Fidelity as well. I also did some work for Fidelity back in grad school, and I got to know them as well. These are just groups that are really in it for the long run. They're not levering up their balance sheet. They're not taking idiosyncratic risks. Remember, our personal capital is invested just like yours with these same custodians. And so nothing's ever secure, and we'll talk about, or perfectly secure, and we'll talk about your protections on the next slide. But of the universe of custodians out there, the two that I feel most comfortable putting my mom's assets in are Fidelity and Schwab. So I'll leave it at that.
Yep, great points. So I'm going to walk through a hypothetical example. So if you're a client of W&A and you have 10 million in assets here, I'm going to go through each bucket and what that means if something went awry and Charles Schwab or Fidelity went out of business, and what does that mean for your assets and what protections are there. So let's say your first million was in cash. So interest, dividends have posted, they've accrued, they're sitting in cash on the account. The counterparty risk would be Charles Schwab Bank. If Charles Schwab went away tomorrow, you do have the FDIC coverage up to $250,000 per individual. And then if it's a joint account, you have $500,000 worth of FDIC coverage. If there was over and above that in cash, Schwab, theoretically, their assets would be liquidated and you would get a pro rata asset recovery for amounts over that. So there is, just like a bank down the street, you have that full FDIC coverage on your cash that's sitting in just a sweep account in your Charles Schwab account.
One other point to make there that I thought was really interesting, because we talked to him earlier this week, just to make sure to kick the tires once again. Of that deposit pool, they've only loaned out 10%. Right. So in the chart I showed you earlier, banks had loaned out 60%. Back in the financial crisis, they loaned out 85%. Schwab's only loaned out 10%. So the bank is in really good position.
So hypothetically, let's say the next 2 million is in a money market. So that is actually at the broker dealer side. So Charles Schwab Inc. or Fidelity, their investment sleeve. So if again, Fidelity or Charles Schwab Inc. were a going concern and going out of business, you actually own the assets, the underlying assets, similar to the segregation of W&A in your accounts. Your assets, you own the underlying assets within these money markets. And then over and above that, if there was a misappropriation or something weird on the account value, you actually have, similar to FDIC on the banking side, you have up to $500,000 in what's called SIPC insurance. So there's a $500,000 protection there. Then they would pro rata, if they liquidated assets, you would get a pro rata on your balance to make you whole. And then also Schwab has a policy through Lloyd's of London, if there was anything else that needed to be added to the account to make you whole, up to 150 million in Lloyd's of London coverage. So we are very confident that, on the money market side as well, that if something happened to Charles Schwab Inc. or Fidelity, that your money market would be made whole because you own the underlying assets within that strategy.
And I will also reiterate that during the financial crisis, they did not break the peg, right? So money markets priced at $1. All the stress that was in the system for both of these major custodians, I think Fidelity may be the biggest money market shop on the planet. Neither of those ended up breaking the buck.
Okay. So let's talk about where the bulk of the assets are and looking at our due diligence on the counterparty risk with the global money managers that we have selected as an investment committee to invest the assets. So in this example, a $10 million account, if we have 5 million in an ETF or a mutual fund, you again own the underlying assets in those strategies. So if Vanguard had financial trouble, their operating entity is separate than your account and you that actually own the individual stocks or bonds in that strategy. So if Vanguard or PIMCO, Invesco, one of those managers went out of business, you still own the accounts. The accounts could be liquidated and transferred to another advisor, another money manager. So you own the underlying assets in that account. So have confidence that if something happened, you again own the account. It's your money, and that's also why we are very diversified in our investment committee selection across managers. And then if you just own stocks outright, what does that mean? So in our example here, if you have 2 million and say Apple, Microsoft, Google, T-bills, you actually own the title directly to you. You own those stocks. And again, if W&A or Schwab or Fidelity, went out of business, you still own those accounts. Those are your assets and you own the individual stocks. Now, of course, it's subject to market risk, but you do own those individual securities. So in this hypothetical example, at each layer of counterparty risk between the bank, the investment companies, the individual stocks that you own, if something happened at each level, you are still covered with FDIC, SIPC, the underlying value that's segregated. And also a point on the investment side, these are very large regulated groups. So we are very confident in the safeguarding of your portfolios.
Yeah, the way I look at this, just to make it simple in my head, is, every once in a while I have to replace my wallet. It'll deteriorate and I have to get a new wallet. But I just take all my stuff, my credit cards, my cash, my driver's license, and I port it over into my new wallet. So if the money market funds, the ETFs, if any of those providers actually went bad, what would happen is that wallet would go away and all of your individual securities within that wallet would just go into a new wallet. So you own those underlying holdings.
It's a great analogy. Thank you. One thing I wanted to bring up is for clients with a significant amount of cash that the cash balance needs to remain in cash for maybe an upcoming expense. We do have a solution that provides full FDIC insurance up to 100 million. And this strategy keeps you from having to go source multiple banks and find to make sure you're covered under FDIC. And you'd have one account, and we go take that burden and shop and get you the full FDIC coverage. And the interest rate's currently paying 4.25% on the first 5 million and 3.95% thereafter. So if you are interested in this cash solution, please reach out to your strategist and they can give you more details on how to do that.
Excellent. Sean, thank you. Before I get this last slide, I know I'm going to get this question because I've gotten it 100 times this week. David, I have X amount of dollars in cash. What would you do if you were me? And these are business accounts. Well, I do think this, if you're worried about the FDIC coverage limits, then you can get around them by going into a feeder like we've got through Focus Cash Solutions, up to $100 million. So if it were me and I had money, over and above 250 grand in any individual account in any bank, really, based upon the differential between the deposit rates and what you're getting on money market funds, I would take whatever's over 250 and I would call the bank and I would say, what's your money market yielding? And if you're not satisfied with that answer, you can call us. I'm not really being solicitous here, although we'd love to have you. But I would leave the operating accounts where you need them. But to the extent that you got overages, if you go into the money market world, you're dealing with an overnight paper that is yielding 4.5% or so. So I hate to contribute to the deposit flight. Leave it at the same bank, buy their money market. That'll help that bank, and they pick up a spread on that. But it's prudent, in the situation of a bank run, you want to be the first person out the door, not the last. All right, I'll stop with that. All right, this has all been kind of heavy material, and I get it. Hopefully you feel better about the safety and security of your assets at WNA, Schwab, Fidelity, our underlying managers. It's important to think about counterparty risk. And I was on the bridge when we went through the financial crisis, and I remember the 1998 crisis, the Asian financial crisis, et cetera. So I've seen a few of these. And so it's important to understand who your counterparties are. So you can have confidence in WNA, you can have confidence in your custodian, as we do at Schwab and Fidelity, and you can have confidence in your underlying managers. Now, that doesn't mean that you're not nervous about what's going on in the markets in general, and rightfully so. We've got volatility bouncing around. And so if you tuned in for our 2023 outlook, you'll remember that I closed with the following thought. The more pessimistic people are, the more excited I get. And here's why. This is a survey that came out yesterday, I think it's today the 16th, 17th, 2 days ago. And it asks investors just like you all, where do you expect the market to be 6 months from now? And 19.2% of you expect it to be higher. 50% of you expect it to be lower. That's 6 months from now. Now there's data on this going back weekly all the way until the mid 80s. And what that data tells us is if you have a belief, and this was my final slide from the 2023 outlook, so I'm going to give it to you again. If you believe the market is going to be lower 6 months from now, and you're one of those, 20% who think it's going to be higher, the returns end up being pretty substantially positive. In other words, the more bearish everybody is, the more bullish it is for the market. So I've gone and looked at that data going back to 1987, broken it down. And for all the occurrences between 20 and 30%, that doesn't even account for, because 19 is so historically low. I didn't even have 0 to 20. But if I had 0 to 20, this number would be 20% higher, so probably 25. So anyway, with the bearish level, or the bullish level, I should say, between 20 and 30%, historically markets are 17% higher. When people feel better than that, 30 to 40% are bullish. They think the market's going to go up. It's 11% higher. When they feel better than that, and 50% of people think markets are going to go higher, they're only up 7% a year later. And when people feel really good and they really suspect the market will be higher a year from now, it actually ends up being lower. So the more pessimism that's injected into the system, the better. And here, let's just play that out. So let's say that Powell is listening this morning and recognizes that by raising rates even further, all he's doing is increasing the incentive for people to pull money out of their deposits and put them into money market funds. Well, that's not good. So if you're Powell, maybe you stop raising rates and then you ask banks, all right, at what deposit level can you actually be profitable in terms of what they pay? And if they say 3.5%, then I've still got a delta of 3.5% to 5 or 4 3/4, maybe I need to start lowering rates. If we get into a situation, that's what the markets are already sniffing out, where Powell is cutting rates 200, 300 basis points, 2 to 3%. Going into mid-year next year, inflation's going to come down for sure because banks have stopped lending. So you've seen commodity prices contract. We got some pretty weak economic data this morning. So the recession is here. So if the recession's here and the Fed's going to cut rates, and we've got all of this earnings power, by the way, that companies are trimming. Look at FedEx today. What a great microcosm of what companies are doing everywhere. As Zuckerberg said, who runs Meta, this is the year of efficiency. They're laying off people at the top of the org structure. They're streamlining, et cetera. So you're going to build in a lot of operating leverage so that when you do have a recovery, you're going to have a whole lot of profitability. And the expectations still hold that profits are up, 15% or so from here going into next year. So I understand why everybody's bearish right now. But unless we have some systematic financial crisis, which I don't really see, it is going to cause the Fed to have to trim interest rates. I think inflation comes down naturally because the inverted yield curve is finally bitten, and that sets us up for the recession we've all been waiting for and have over-prepared for, which then sets us up for the recovery, which could be robust and returns could be pretty great. So yes, it feels scary today. But because it feels scary today, the fix is on the way and we'll make money off of that fix. All right. So that, without any scripting, is the message of the morning. So from here, I think we'll open it up for questions. And of course, happy to talk about just about anything.
Thank you. Yes, David, we do have a few questions that have rolled in. The first question, if we are entering into a recession, will we retest those October market lows?
So the market bottomed at 34.91 on the S&P, and we are currently trading at 39.12. So even with the VIX going through the roof, with the recession alarms ringing, we're still 500 points above where we were in October. And again, my thesis for this year has been, we got this year's recession returns last year, and we'll get next year's recovery returns this year. I believe that thesis remains intact. The government has shown that they will act quickly and decisively. Powell has certainly exhibited that through his tenure. So I don't think they're going to allow the liquidity issues in the banking system to basket toss a whole bunch of banks and lead to a whole bunch of bank failures. I just don't see it. That being the case, I think this is more akin to kind of the flash crash in 2010 and less akin to the great financial crisis in 2008. So I think the bottom is in. We may retread, some of this, some of these returns that we've received since then, but we're up 13%. We've got a lot of wiggle room there. So there's some sorting going on. People are saying financials probably won't be as profitable. I agree with that. Could that change some of the way that we're addressing the portfolio? It might. We've got more work to do there as an investment committee, but I don't see us going back to those October lows. We went down 25% top to bottom. Typically in a recessionary environment, markets go down 24%. So we already did the damage we needed to do just to be at the median of history. So no, I don't think we retest the lows. Doesn't mean we go higher necessarily tomorrow from here, but by the end of the year, we're higher.
Okay. So next question, which we do get a lot. Why are people still buying Bitcoin?
So we don't own Bitcoin, so I'll throw that out there. But the case for Bitcoin is if you believe there is going to be systematic collapse, then you want to own Bitcoin theoretically. If you believe that the government is going to do a whole bunch of quantitative easing, you want to own Bitcoin. So I don't have the slide on this, but the government has been tightening at about 100 billion a month, shrinking the money supply. Within the last week, they printed 300 billion of new dollars. So the case for Bitcoin is it's the anti-dollar. And if you think the government's going to print $2 trillion worth of dollars to backstop the liquidity in the financial system, then it makes the case for Bitcoin, I suppose, to those within the religion. That's not what we're doing with client assets. It's far too volatile. But because it's a small market cap, remember, it's only $1 trillion in market cap, which sounds like a lot, but the global economy is 100 trillion and it's printing that every year. And so it doesn't take much in terms of buying energy to create these sort of hockey legs higher in a small commodity, really like a Bitcoin. So there's a case for it in those circles. There's a lot of cash on the sidelines. So it's pulling some of that energy in, most of it linked to this idea of quantitative easing infinity, which I don't really think is necessary, but it went from what 65,000 to 18, and now we're at 26. So not a ride we want to be on, but that's my answer.
Right. Thank you. Next question. With the rapidly changing environment, do you foresee any changes in your models?
Well, I sort of was alluding to that. We're always, all right, let me say it this way. We don't like to trade a lot because historically, if you look at the velocity of the portfolio and the returns over time, they're inversely correlated. So you're better off buying high quality stuff, tweaking periodically. But if your strategy is day trading, I don't know any Warren Buffetts who got on the cover of the magazines because they were great day traders. I just don't. So we're not in the business of really trading, but we are in the business of tilting. And you'll see it within our portfolios. And so does this cause us to tilt one way or the other? Not quite sure yet, but every morning that you wake up, you're a net buyer. So I wake up every morning, look at the portfolio, and I better be in love, right? If not, then we meet as a committee and we discuss potential tweaks that can be made. So I don't have anything, I don't think, as a committee that we've described as urgent that we'd have to change, but this gives us a great opportunity to go back, look inside the holdings, and see if we really think it's going to be a severe recession. And I'm not saying it is, but then maybe we think a little bit less about small caps. And maybe we want to go up a little bit more on the quality spectrum, because maybe people will have difficulty borrowing from banks, and therefore we want more companies that can self-finance. So these are discussions we're getting ready to have, but at the moment, I don't have any portfolio changes to announce.
All right. We have time for one more question. With all of this news, how do you think that impacts the dollar?
That's a really interesting question. Obviously, the way that we're positioned, we would like to see the dollar fall. Part of the reason the dollar was strong is that inflation rates outside the US were a little bit higher, but we were a little bit tighter. So the European Central Bank raised rates 50 basis points. They're still well below where we are. So we were the relatively tight central bank on the planet. They've got one bad bank for sure, which is Credit Suisse, but I think that's sort of because it's just a bad bank, right? We're experiencing some systematic issues. That puts us in a more dovish posture, I think, as a central bank, maybe than the Japanese central bank right now or the European central bank, which are basically the only two currencies that matter in relation to the dollar are the euro and the yen. So if we end up becoming more dovish in that group, then that ends up being bearish for the dollar. So I think the Fed will have to soften, if not, going into pause mode next week, at least announcing that it's going to pause after raising 25 basis points for the textbook opinion of whether the credibility of the Fed is something you can rely on. So my expectation is that we continue to see a decline in the dollar unless we get into crisis mode, which I don't think we're going to. And then everybody on the planet just stuffs the dollar, stuffs the treasury market. But absent some sort of systematic crisis, which again, I don't think we're going to have, I think the dollar's bias is weaker.
Perfect. Thank you. For the questions we didn't have time to answer, your strategist will reach out to you with an answer. So with that, David, closing remarks.
Yeah, Sean, thank you so much. I appreciate you picking up some of the burden here. And again, Nicole, who's out in California, thank you for not sleeping and getting these slides beautiful for us. That is important to me. I want high quality in everything we do. And for all of those at WNA who gave up some spring break time on the beach to be able to help and put this together, I'm super grateful. And for all of you as clients, my hope is you feel signing off from this the way I felt leaving my dad's living room, a little bit more comforted, things a little bit more clear, and feeling like you got a safety net, because that's what we want to be for you. So thank you all very much. Have a great weekend, and we're here to help in any way, shape, or form. Just give us a call. Thank you.